Good morning once again. Uh, Today we are going to discuss about accounting conventions. As in the last video, we have discussed about accounting concepts, various accounting concepts. So, my name is Priyanka Mahanta, Assistant Professor, Business Administration Department, USTM. So, let's begin our today's video, which is accounting conventions. So, first of all, what is accounting convention? The dictionary meaning of convention states that it is a custom or a way of doing or acting things that is widely accepted and followed. As we already discussed that concepts and conventions means that it's a kind of rules and regulations that the accountant need to follow while preparation of the financial statement of the company. Okay, so basically the term convention includes those customs and tradition which guide the accountant while preparing the accounting statement. So this is what we already discussed now. So it is not a legal binding upon them, but the general agreement on the usage and practices in social and economic life. That is, it is a customary practice, rule or usage. They are derived from usage and continuous practice. So the accountancy bodies of the world may change any of the convention to improve the quality and standard of accounting information. As we have already discussed that the concepts and conventions are definitely rules and regulations or kind of guidelines that they need to follow, but it's not rigid. Okay, it's not rigid because it is man-made. It is not any kind of natural law, so it can be changed according to the need. Okay, so all the accountants who are working on these concepts and conventions, they try to modify these concepts and conventions according to the change in the environment. Okay, so let's see one definition over here. According to MWE Gautier and B. Underdown, the term accounting convention serves in another sense to understand the freedom which accountants have enjoyed in determining their own rule. Okay. Now, why do we think that we have to say conventions matter? Why does it matter? So actually, accounting convention provides a standardized methodology, okay, that creates a reliable means of comparing financial results from industry to industry, from year to year within one industry. That means we can use it for comparison purpose. If there is company A and there is company B, we need to compare between two companies to see whether which one of the company is better. So with the help of the financial statement of both the companies, we will decide, right? So accordingly, accounting conventions govern how companies and accountant prepare quarterly balance sheet or income statement or annual reports. Okay. So following the set of convention increases the reliability of the data. Okay, reliability of the data means whether it is useful to the user or not, how reliable the data is. Okay, whether we can rely on that particular data or not, or we can say the data is true or not. Okay, so it helps in the reliability of the data. It maintains uniformity among all the industries, all the companies, and helps the accountant in recording only the relevant information. Okay. Moving on, classification of accounting conventions. Now we have four conventions, like we have eight concepts, right? We have eight accounting concepts. Now here we have four different accounting conventions. So let's see what are those. First one is like be conservative, okay, which is termed as conservatism. Disclose in full, that means full disclosure. We will understand in detail. Be consistent, that means it's consistency. Report only that thing which is important, which is termed as materiality. Now let's discuss one by one in detail what these conventions actually mean. Now the first one, convention of consistency. By the term consistency, I think all of you can understand what is consistency means. Like for example, if you study 1 hour at home every day, you should maintain that. Every single day, you need to study 1 hour at least. So that is consistency. You are consistent in your work. Okay, it should not be today I'm not going to study, tomorrow I will not study, like that. That's not consistent. Okay, so you need to be consistent in your work, because consistency gives you better results. Okay, so accounting rules, methods, practices, and conventions should be continuously and consistently observed and applied. That is, they should not change from one year to another. That means if one company is following one set of standard, and again in the next year they're changing the standard, and they year by year if they're changing the standard, that means they cannot even do comparative analysis of their own company from year to year, because they are using different set of standards, right? Last year they have used certain different rules and regulations, again this year different rules and regulations, so it will be a chaos situation for them. So they need to maintain the consistency. It means that they should follow one single set of standard that they need to follow every particular year. So the accounting information provided by the financial statement would be useful in drawing conclusion regarding the working of an enterprise only when it allows comparison over a period of time as well as with the working of other enterprises. And this comparison is possible only when consistency is maintained throughout. Okay, so consistency ultimately means that they should report their financial statements in a consistent manner, following the same or similar rules or standards every year, so that they can do company comparison as well as inter-enterprise some kind of comparison. Actually, the rationale behind this concept is that frequent changes in accounting treatment would make the financial statement unstable, okay, incomparable and unreliable, and may seem difficult to be compared by person who uses them. If I make certain changes every year, definitely the user will find it very difficult, because they cannot be able to compare it. Okay, now consistency also means external consistency. That is, the financial statement of one enterprise should be comparable with the another one. So it means that every enterprise should follow same accounting method and procedure of recording and reporting business transaction. This will help in inter-firm as well as intra-firm comparison. Okay. Now, it doesn't mean that this convention will restrict or prohibit completely no change. It's not like that. Okay. It does not differ from introducing or some kind of improvement in the accounting technique. Definitely the accountant can do that. They can have some kind of improved version of the accounting technique. So however, if a change becomes desirable, the changes and its effect on profit and financial position of the company as compared to the previous year should be clearly stated in the financial statement. Okay. Moving on to the next one, which is full disclosure. Now, by the word itself, full disclosure, we can understand. Full disclosure means that the company needs to disclose everything. They cannot hide anything from the general public or from the owner of the company or from the shareholder. They need to disclose each and every information about the company. So information provided by financial statement is used by different groups of people, right? Like the owner, like the investor or lender, supplier, etc. Okay, and this financial statement, they use it for taking financial decision, right? If I am an investor, I'm going to use the financial statement, and according to the data provided in the financial statement, I am going to take my decision whether I am going to invest in that particular company or not. So, in order to make sure that correct financial decisions are taken, the accountant should be prepared in such a manner that all information, whether good or bad, it doesn't matter. It doesn't matter that only the good things you will show to the public and all the bad things you will hide. No, you cannot do that. Okay, whether it's good or whether it's bad, okay, it should be disclosed in the report, and no information should be concealed from the interested parties. Okay. So according to this convention, all accounting statements should be honestly prepared, and to the end of full disclosure of all significant information should be made. So all information that carries some interest to proprietor or to the creditor or to the investor should be disclosed in the accounting statement. Okay. Since financial statements are the only mode of communication, that is communication between the business and the user of the financial statement, the financial information to all the interested parties, it becomes essential that accounts make a full or fair and adequate disclosure of information so that they can take proper financial decision. Okay, so I hope it's clear. So moving on to the next one, which is convention of conservatism. So the concept of conservatism provides guidance for recording transactions in the books of account and is based on the policy of caution or playing safe, and has its origin as a protection against possible losses in the business world of uncertainty, because business is all about uncertainty. Okay, it's all about taking risk. The more you take risk, the more you may earn profit. Okay, this is the mantra of business. But we all know that there may be certain things that is uncertain. Okay, we cannot predict the future, right? We need to be safe. We need to protect ourselves from all the uncertain things that may happen to us. So for that purpose, this concept of conservatism is one of the main, we can say, convention which is developed. So this concept states that a conscious approach should be adopted in ascertaining income so that profit of the enterprise are not overstated. Okay, so if we just overestimate our profit and we don't think about the loss part, then it's difficult. Okay, it will make us fall in a difficult situation. So what we can do is, it compels a business to wear a risk-proof jacket. Okay, for the working rule is anticipate no profit but provide for all possible losses. That means you think that you have no profit but still be ready for any kind of possible losses. Until and unless you are ready to accept the losses, you cannot win in the market. You cannot win in this competitive environment. Okay, so we need to make clear that whatever scenario may come, whatever uncertain scenes may come, we need to protect the company from all the uncertain losses that may occur. So this means over-optimism in reporting result is considered more undesirable than over-pessimism results, because it shows position better than what actual financial position is. So some of the example of application of convention of conservatism are valuing closing stock at cost or market value, whichever is lower, creating provision for doubtful debt, writing off intangible assets like goodwill, and discount to debtors like this. So these are the things which we can undertake while making the financial accounts. Like for example, creating provision for doubtful debt. Suppose if the company has given some kind of loan to someone, okay, so they have to make a condition over there that maybe I'm not going to receive this money, kind of doubtful. I'm doubt that they are going to return the money. Okay, so we need to see these things. Now, why this conservatism convention is important? So the benefit is being conservative while preparing the accounts is that at the end of accounting year, it is always better that the net asset and net income are understood rather than being overstated and misleading the investors by depicting false image outside, which might run after investors come to face the reality. Okay, so we need to be clear about this thing. Next one, conservatism of materiality. So last conservatism is conservatism of materiality. So the concept of materiality requires that accounting should focus on material fact. It means whether something should be disclosed or not in the financial statement will depend on whether it is material or not. So effort and time should not be wasted in recording and presenting facts which are immaterial in the determination of income. So the term materiality is a subjective term. Okay, the accountant should record an item as material even though it is small of amount and its knowledge seems to influence the decision of the proprietors or auditors or investors. Now let's take an example. For example, commission paid to sole selling agents, okay, should be disclosed maybe separately in the profit and loss account. Okay, similarly, amount due to directors, okay, or some other officers should be disclosed separately in the balance sheet of bank to know the exact amount of advances due, okay, which are due to from directors and officers who are managing the affairs of bank. So any fact would be considered as material if it is strongly believed that its knowledge would influence the decision of informed users of financial statement. Anything which it may be a small thing, but even the small thing sometimes matters. So we need to judge properly whether this thing should be included or not, because this small thing sometimes may be helpful for the user to take certain big decisions. Okay. So it means that the company needs to see how they are obtaining the fund. That means the source from where they are going to acquire the fund. Maybe from bank loan, maybe from equity, or maybe from debenture. So they have to decide which source they are going to choose. And second thing is that they need to keep in mind that it should reduce the cost of fund. Cost of fund means the expenses that are involved to acquire that fund. Like for example, if we say, if you're taking bank loan, the cost involved in it is the interest that we have to pay to the bank. Okay, so we need to be careful while choosing the source of fund. We need to see which source of fund will be beneficial for us, or which source of fund will be having low cost, okay, or we can say low expenditure. And another thing is that whatever money we have procured, the company should see that proper utilization of the fund has been done. Okay, like it should be in optimum use. So financial management involves two dimensions, that is finance and management. So hence financial management can be said as the application of management function. So financial management is very important as it has direct emphasis on the financial health of a business. Financial decision management decision affects all the items of financial statement directly or indirectly. Now let's see the importance of financial management. What are the importance of financial management? So the first one is the size and composition of fixed asset of the business. So over investment in fixed assets may block fund. An increase in the size of fixed asset but may not be healthy for business, whereas little investment may hamper the growth of business. In short, if we try to understand this, is that if we invest more in fixed asset, our funds will get blocked over there, but definitely yes, the asset part will go up. Okay, but if we invest low in the fixed assets, then our growth of the business will be deprived. So we need to be careful, and proper deployment or division of funds should be there. How much money to invest? It should neither be too much or neither be too low. Okay. So the next one, the quantum of current assets and its breakup into cash, inventory and receivable. So the financial decision about investment in fixed asset, credit policy, inventory management, etc. influence the amount of working capital required by a business enterprise. So the division or the breakup, how I am going to manage my fund, how much of money should be in cash, how much of money should I invest in my inventory, and how much of money should I invest in some other things. Now, definitely for running the business smoothly, they need working capital, right? What is working capital? Working capital means the amount of money which the business requires to run its day-to-day operation. Okay, that means in day-to-day life they may have certain issues, certain problems, or they may require the fund. They should keep some liquid fund with them so that immediately they can take certain actions. Otherwise, there will be delay. Okay, so for the smooth running of the business, working capital should be maintained. Next one, breakup of long-term financing into debt and equity. So it is important for a financial manager to decide the way by which the proportion of debt and equity in business has to be pumped in. That means how much proportion of debt fund you are taking and how much proportion of equity fund you are taking. So the company should have a proper proportion of it, which will be beneficial for them. Okay, maybe it's 50-50 or 50-40, like that. Okay, they should have a proper proportion of debt and equity pumped into the business. So the decision of financial manager affect debt, equity, share capital. It will affect the preference share capital and is an integral part of financial management. The next one, the amount of long-term and short-term financing to be used. So financing decision decides the proportion of funds raised from long-term and short-term sources. That means the financial manager will help us to know how much money should we draw from the long-term sources, that is more than 1 year, and how much of funds should be acquired from short-term sources like less than 1 year. So this will depend upon the need and the use of the fund. Okay, for what reason they need the fund. Accordingly and based on that, they can choose the source, whether long-term or short-term. The last one is all item in the profit and loss account. That means financial decision affects the value of item appearing in the profit and loss account. Now we can say that financial decision by the financial manager in the past largely affects the current financial decision as well as future financial decision. Okay, so the overall health of finance is determined by quality of financial management. That's why financial management is an important thing for each and every company. Now moving on to the objectives of financial management. This is the we can say the main thing that we should know about financial management part. Okay, so the first objective of financial management is profit maximization. So by the word itself, we can understand what the meaning, right? Profit maximization. That means what? Increase in the profit, right? And to its maximum level. Increase in the profit. So definitely for every business, it is their objective. It is their aim to earn profit. Why do people do business? Because they want profit. So definitely for every business, profit maximization is their prime objective. Okay, but not only profit is important. We also need to see nowadays some other aspects as well. So here, this was the primary objective of firm which are concerned with the increasing of per share earning per share, that is EPS of the company. It is also the traditional objective of financial management that focuses on the fact that all financial effort should be made to increase the overall profit of the company. So ultimately this profit maximization objective is such that they don't see whether this is right or wrong or what we are doing. Their main objective or the main vision is to earn profit. So for earning profit, they can do anything. Okay, but nowadays people don't only go for profit earning profit earning only. They also need to see the other aspects. Okay, because if they don't see the other aspects, then they may lose their market shares. Okay, moving on to the next one, which is wealth maximization. Now this is the main objective of we can say financial management. okay, which is wealth maximization. So financial management mainly aims to maximize shareholders' wealth, which is also referred to as wealth maximization. See, here the company is not just seeing about their own profit, but here they are trying to maximize their shareholders' wealth as well, right? So this objective focuses on increasing the overall shareholder wealth of the company by directing the financing effort on increasing the share price of the company. Now, how they are going to increase the share price of the company? It depends upon the market, right? I think all of you know what is share market. We will discuss this in our coming videos and session. So the goodwill of the company also affect the share market, so they cannot just do anything and earn profit. Okay, so they should maintain the goodwill, because goodwill in the market is important to sustain in the market and also to increase their share price in the market. Okay, so until and unless they increase the share price, they are not going to help the shareholders anyway. Okay, so higher the share price, higher is the wealth of the shareholder. The goal of financial management in this is to optimize the current value of company's equity share. The market price of share of the company are highly influenced by the financial decision of the company. Whatever financial decisions are taken, okay, how much money they are going to invest, where they are going to invest, such kind of decisions which reflects in the financial statement, it influences the decision of the investors. Okay, now, wealth maximization is a goal, we can say, that all individuals and business should aim to achieve. Not only will it will improve one's quality of life, but we can say that such wealth maximization will help sustain the company's business in the long run. While we can say that wealth maximization is the company's objective, profit maximization is the objective of every company owner. So they should not only focus on the prime thing that we need profit anyhow, but they should focus on the overall wealth of the company, so that they can sustain for a longer period of time in the market and they can capture the whole market. So in other words, if we say uh, in short, if we try to understand this, wealth maximization is the maximization of owner's wealth, and its value is calculated by computation of stock value. So hence, maximizing wealth is comparatively different from maximizing profit. Okay, so I hope we have done this clear. So if we talk about profit, I think all of you know what profit refers to, right? It is the amount of money you can make on an investment or business or venture, while wealth refers to and describes your overall financial situation and net worth. Okay, the term net worth is used to describe the wealth part. Okay, so it may seem that making profit is always good, but actually not. Okay, but there are some situations where increasing and solely relying on profit could prove to be detrimental to the health of the company and negatively affect the overall wealth of the company in long run. Okay, so that's all for today's video. We will continue in our next video. Thank you.